Girl, we are buying a house this year, period. Even if you have debt, even if you have student loans, even if you have credit cards, even if you have car loans, baby, you can still buy a house. And let me tell you how. So the truth is, lenders don't care that you have debt. As a matter of fact, debt is seen as a good thing as long as you keep it in check, okay? People who have no debt can't get approved for a home loan. What they really care about is something called your debt to income ratio, your DTI. Essentially, how much of your income is being used to pay your debt. That is the number that actually matters, not the amount of debt that you have, but how much of it is eating up your income. This number carries so much weight, it literally determines how much home you can get approved for. So the lower that number, the better. So let me tell you how to calculate it and then what number the lenders are looking for. So it's easy to calculate. All you got to do is look at your credit report. Add up all of the minimum monthly payments for all the things on your credit report. That is your debt. Next number that we need is your income, which is literally your annual income before taxes are taken out. Take your debt and divide that by your income, and there you go. You have your DTI. And that is literally the math that lenders do. Now, the number that lenders are usually looking for before you add a mortgage to that is going to be no more than 20 to 25% max. So if you have over 25%, it's not the end of the world. That just means we got a little bit of work to do. So comment and let me know what your DTI is so we can see what we need to work on, okay? Because girl, we are buying a house this year, period. And we're not going to let debt stop us, okay?
Hey guys, welcome back to the channel. Man, I had to listen. See, that's why you got to listen to the full story, because I was about to, man, you tripping. You're going to get these folks in trouble. But I think I know where she was going, and I agree from the premise that lenders look at your debt to income ratio. I don't agree with you buying a house, being in debt, as she said, if you can't afford it. And the reason I changed my mind, and she's an excellent marketer, by the way, great video. She said 20 to 25%. So if you are buying a home and you can do so with all of your debt that's represented on your credit report and undisclosed debt that a lot of you guys have nowadays, Klarna, Affirm shows up on the credit report now, but buy now, pay later accounts, those are undisclosed debts. Any debt that's not going to show up on the traditional credit report, you want to make sure you add that in. But I would say this, you also want to look at other obligations that you have in your daily life. Go back 3 months, look at what's recurring on your bank statement, all of the subscriptions, all those things, because to her point, we're looking at your debt to income ratio, but we're using your gross income and you live on the net if you're a W-2 employee. And so you have to understand that besides the great looking content and some of the message, which I know she's trying to get you to reach out or get on a list, so on and so forth. The reason for the social media, in my opinion, is you guys are looking for the information. You don't want to be gate kept. And then you'll choose who it is that you want to deal with. So no shade to her, but for those of you that don't know, it ain't that easy and you don't want to jam yourself up. So I'll restate, if you're going to calculate your debt to income ratio, remember that 20 to 25% that she's talking about, which I like that percentage, it's based on your gross income. You live on the net. So if you can figure out, get your pay stubs, however you get paid, weekly, bi-weekly, semi-monthly, or once a month, and look at how much is coming out, taxes, insurance. Hopefully you're doing your retirement stuff if your employer, has some type of 401k, 403b, so on and so forth, TSP. After all that's taken out, the number that you're actually going to live on, if that's 20 to 25%, you Gucci, golden, I'm with her. But more times than not, I'm seeing folks buying homes and the debt to income ratio is a lot higher, and that's danger. Because you live on the what? There you go. You live on the net, not the gross. So shout out to her, not knocking her, but we wanted to add a little bit more so that before you reach out, you understand the full matter. If you don't agree, let me know down below. Because you know what? I'm always learning. Let's continue.
We're increasingly realizing that the 25 and 26-year-old in America has been screwed by the large banks and the car companies like never before. You cannot buy a house when you have a $1,200 car payment, when you have a student loan that's $85,000, and you got credit card debt coming out your ears. Record credit card debt, record car debt, record debt.
Yeah, Uncle Dave or Papa Dave is speaking facts yet again. And this is why what I was saying earlier from the last creator, you want to look at your net, because you may have student loan debt And from a lending standpoint, even if that student loan debt is on some type of income-based repayment plan or deferred, or you're not making the payment on it, we're still going to allocate a payment for you. And some of you guys have 6-figure plus student loan debt. And so that's something that you cannot overlook when we're talking about DTI and or getting into additional debt. It may not be the right time for you. You may need to hunker down and knock off some of this debt. Secondly, these car payments are egregious. I'm talking about regular, degular, schmegular vehicles. $40,000-$45,000 is crazy work. These car payments are the old mortgage payments. I digress. These are things that you must account for. And if you're younger, you have to try to eliminate that debt or not get into it. That's how you eliminate it. How you do that, Robert? Trade school. Go to community college, live at home, go to your state university, work while in school, do all you can to stay out of the debt because the borrower is serving to the lender. And it always feels like when you're in school, out of the workforce for 4 years, if you're not doing it for the right profession that you know is commiserate of you being able to pay that debt within 4 years after you getting out of school, don't do it to yourself. Listen to Listen to the old man. Listen to Papa. A lot of folks don't like him because of the delivery, but he's spitting facts. And so for those of you that find yourself in that situation, stay encouraged. Here's the deal, reverse engineering. How long can you live at home? While you're at home, you can't take that margin, that delta that you're creating because your folks are allowing you to live there and go kick it. That's no bueno. You have to get laser focused, have a plan of action. I think he's always talking about the snowball method or the avalanche method. Simply list them, meaning your debts that you owe from the least to the highest or vice versa, however you're wired. And then you got to attack that thing to get out of debt ASAP before you look to buy a house or anything else. So I agree with him. Cars, student loan debt. A lot of you guys have been hoodwinked and bamboozled. So hopefully going forward, we can start eliminating that from happening, not because we're waiting on someone to change the rules, but because you guys become more savvy before going into that type of debt. Let's continue.
You know, I was having a conversation with my mentor today, and we was talking about how much do you really make and how much do you actually bring home. You got people that make 100 or 150K, but how much of that is going out to bills and how much of that money do you actually see coming in? Because you can make $100,000 or $150,000 a year, and you can be living above your means, meaning you paying an exorbitant amount for rent or mortgage. You could be paying something crazy like $3,000, $4,000, or maybe $5,000 a month just because you feel like you can afford it. And you got maybe 1 or 2 cars brand new cars that you're paying for at the same time, which also carries insurance on everything that you have going on. And that's not to mention all the other little odds and ends bills that you got coming out your paycheck, like cell phone, you may got cable, or whatever it is, you got you got more money coming out than you got coming in. So let's say you're trying to make a move. You're trying to make a move, like you're trying to go get you a 3 or 4 unit. You feel like, hey, I make $100,000 or I make $150,000. Yes, on paper, you make $100,000 or $150,000, but the banks are looking at what you actually bring home. They're gonna look like what's coming out your account, what bills do you have, and they're gonna subtract that amount from your total amount, and they're gonna say, well, you may not have enough to actually, even though you make 100 to 150K, you may not be bringing home enough in order to acquire this asset from us. In layman's terms, this is called your debt to income ratio. That's exactly what the banks are looking at when they run your motherfucking credit. They basically, in a nice way, saying, we don't trust giving you this loan for this building because you have poor fucking money management skills. And this is something my mama taught me when I was a kid. And this always stuck with me as I was growing up. It's never about how much you make. It's always about what you do with the money that you make. Because you can make $80,000 a year and you're living below your means, but you're bringing home more than your bosses that make over $200,000 a year, all because they have poor money management skills. Because a person making $30,000 right now that's living paycheck to paycheck, they can wake up tomorrow and make $200,000 for the rest of the year, and I guarantee they still gonna be living paycheck to paycheck. This is why I always preach: stay below your means. Have a long-term game plan. Think 5, 10, or maybe 15 years out. Where do I want to be? Where do I want to see myself? Then just start implementing that game plan. But really, you got to sit down and ask yourself, out of how much you make, add your bills up, how much do you actually take home? That's your homework assignment for tonight.
Yeah, I can't say I disagree with him, and his mentor's giving him a lot of game. Key takeaways that he said: living beneath your means. That's like a cuss word to a lot of us. And why is because of what we have said throughout the video. You don't live on your gross income. Even if you're self-employed, you have to make sure you put out some monies for the tax man and pay him when he's supposed to be paid. But the difference with self-employed opposed to W-2 is if you're doing it the right way, you have more tax write-offs to help you keep that money longer. When you're W-2, it goes directly to them people. And if you want to know who them people are, look it up in the colorful dictionary. That's the government. You know, them alphabet boys, the I, R, and the S, and everybody else that's in your pocket. FUTA, FICA, I can remember my son and my daughter when they first started working. My son was like, Dad, who's FICA? I said, that's them people. And my daughter said the same thing. Who is this FUTA? Baby girl, that's them people. And so I digress. My point is you gotta live beneath your means. And the earlier you can start that, the better off you'll be. He spit a bar that I guess his mom taught him, because here's the deal. You could be making $10 million a month. If you spend $10 million in $1, you poor, you broke. And you know what, guys? Since you stayed this long, I'm gonna drop a jewel on you. Come close, a little closer. I'm gonna whisper it. You will never be satisfied. You'll never be satisfied. You have to discipline yourself to say, I'm content. That's enough. Someone else will always have more than you have. You see? So this is the game going from consumption to wealth building, and you have to plan. So I'm going to give you a homework assignment. He gave you one. I want to give you one. Here's the deal. Whatever you're making, I want you to go to the IRS tax tables. We have a progressive tax table, meaning certain dollar amounts are subject to certain percentages. But I want you to go based upon whatever your annual income is, and I want you to figure out how much your federal tax obligation is. Because as a planner, you can start planning now in the beginning of the year and then take advantage of the tax law to help you out. So that's the homework assignment. How much are you bringing home after them people, in this case, the federal government? Some of you guys got them people and their cousins because you're paying state taxes as well, but we're just going federal, and figure out what your net number is. And then from that number annually, you could divide it by 12. That's how much you bring home a month. And then figure out what your real debt to income ratio is so that you can plan from that standpoint on, do I need to increase my productivity? Do I need to invest in myself to make myself more valuable, to attract more dollars so that I can achieve this goal or get into this business? He's mentioning investment properties. Excellent business to get into if you can, but you got to have some money, right? All these things start with planning and knowing your numbers. If you've done that homework and you say, Robert, you know what? I'm ready to go. I want to buy 1, 2, 3, or 4 units, residential real estate. Well, I'm a lender. My NMLS license number is 180100, and I would love to have a conversation with you. My contact information is in the top pinned comment or in the description of this video below. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let us let grace abound. Watch these next 2 videos. They'll help you on your journey to becoming either a homeowner or an investor in this case. And for the rest of you, y'all stay blessed. Indeed.